The U.S. automotive industry is facing one of its most turbulent periods in recent memory, as uncertainty and anxiety ripple through factories, dealerships, and boardrooms across the nation. At the heart of this storm are industry giants Toyota and Honda, who are now considering drastic changes to their U.S. operations in response to a new wave of aggressive tariffs. These tariffs, introduced with the intention of boosting domestic manufacturing and protecting American jobs, are hitting Japanese automakers especially hard, threatening not only their U.S. operations but also the livelihoods of thousands of American workers who depend on them. The potential withdrawal or downsizing of these automotive giants could send shockwaves through the American economy, affecting everything from local communities to national supply chains. For decades, Toyota and Honda have been integral to the U.S. industrial landscape, providing stable jobs, investing billions in local economies, and fostering innovation in automotive technology. Their deep integration into the U.S. market means that any disruption to their business is felt far beyond the factory floor, impacting suppliers, dealerships, and even consumers. This situation challenges a long-standing economic partnership between the U.S. and Japan, one that has been built on decades of trust, collaboration, and mutual benefit. The new tariffs are disrupting global supply chains, making it more expensive and complicated to move cars and parts across borders. These policies impose heavy taxes on imported vehicles and components, driving up costs for manufacturers and, ultimately, for American consumers. For Toyota and Honda, this is a direct assault on their business model, forcing them to make tough decisions about their future in the U.S. The stakes could not be higher, with billions of dollars in investment, thousands of jobs, and the overall stability of the U.S. auto sector hanging in the balance. The future of the automotive industry in the U.S. is now uncertain, as companies, workers, and families wait anxiously to see what comes next. If these challenges are not addressed, the country could face long-term economic disruption, with ripple effects across multiple sectors. The decisions made in the coming months will shape not only the future of the industry, but also the lives of millions of Americans who rely on it for their livelihoods and mobility. New trade policies are dramatically reshaping the automotive industry, introducing a wave of uncertainty and forcing companies to adapt at an unprecedented pace. As governments around the world implement new tariffs and regulations, automakers are finding themselves at a crossroads, needing to make quick decisions to stay competitive. For example, a 25% tariff now affects operations with Canada and Mexico, two of the United States' largest trading partners in the automotive sector. This policy shift has immediate consequences, impacting the flow of vehicles and parts across borders that were once open and efficient. The result is a major disruption to supply chains that have been optimized over decades. Automakers are now forced to rethink their logistics, sourcing, and production strategies, often at significant cost and with little time to adjust. Meanwhile, a new bilateral agreement with Japan has introduced a 15% tariff on vehicle imports. However, the specifics of this agreement remain unclear, leaving many companies in a state of limbo as they try to plan for the future without knowing the full rules of the game. The financial impact of these changes is staggering. Automakers are absorbing billions of dollars in additional costs, which not only affects their profits but also limits their ability to invest in research, development, and innovation. This could have long-term consequences for the industry's global competitiveness. For consumers, tariffs act as a direct tax, squeezing profit margins for manufacturers and driving up the price of new vehicles. Shoppers are already feeling the pinch with higher sticker prices and fewer incentives available at dealerships. The trade war doesn't stop at cars and parts, it now extends to semiconductors, which are essential for the advanced electronics in modern vehicles. Restrictions and tariffs on these components further complicate production, leading to delays and shortages that ripple throughout the industry. All these interconnected barriers are raising both the cost and complexity of building cars in the U.S. Automakers must navigate a maze of new rules, tariffs, and supply chain challenges just to keep their factories running. The industry now faces a challenging and uncertain landscape, with tariffs and trade barriers affecting every aspect of car manufacturing, from sourcing raw materials to delivering finished vehicles to customers. The road ahead is anything but smooth. Toyota, a global automotive giant long seen as a symbol of stability and innovation, now faces severe financial strain from U.S. tariffs. Once celebrated for its resilience and efficiency, the company is grappling with a new reality that threatens its very foundation. In a single quarter, Toyota reported a staggering $3 billion loss, a figure that sent shockwaves through the industry and left analysts questioning the company's future direction. This dramatic downturn highlights the unprecedented pressure on their business model, forcing Toyota to slash its profit forecast by 16%, a move rarely seen in its storied history. The market responded swiftly and harshly. Shares tumbled, reflecting investor anxiety and signaling the trade war's immediate and far-reaching impact on the automotive sector. In an effort to protect its loyal U.S. customer base from sudden price hikes, Toyota absorbed much of the tariff costs itself. This strategy, while customer-friendly, has put immense pressure on already thin profit margins. The company now finds itself caught in a difficult balancing act, struggling to maintain its hard-won market share while also safeguarding its financial health and long-term viability. Toyota's massive investments in U.S. manufacturing, once seen as a strategic advantage, have become a liability as tariffs disrupt the flow of parts and vehicles across borders, complicating logistics and increasing costs. These ongoing financial losses have sparked intense debate within Toyota's leadership, raising urgent questions about the company's long-term strategy in the U.S. market and whether its current approach is sustainable. Takanori Azuma, Toyota's head of finance, has acknowledged the gravity of the situation, emphasizing that the company must now confront a series of tough choices in an increasingly hostile and unpredictable market environment. The recent shifts in global trade policy have exposed vulnerabilities in even the most robust and well-managed corporations, challenging long-held assumptions about international business. As Toyota navigates this turbulent period, its future in the U.S. remains uncertain, with significant challenges and difficult decisions looming on the horizon. Honda faces challenges from U.S. tariffs but is taking proactive steps to limit financial damage. They've reduced expected tariff impact by 31%, adjusting supply chains to minimize exposure. Honda considers expanding U.S. production to reduce reliance on imports. This strategy requires significant investment in workforce and infrastructure. Despite efforts, Honda's profit margins remain under pressure from tariffs and EV transition costs. The dual financial strain makes maintaining stability difficult. Honda's adaptability is tested in a volatile trade environment. The company navigates a path of cautious adaptation amid shifting policies. The trade uncertainty complicates long-term planning and investment. Honda's strategy reflects the complex trade-offs automakers face today. U.S. automakers are realigning strategies in response to tariffs. GM invests $4 billion to onshore production, moving models from Mexico to the U.S. This shift is a reaction to tariffs, despite higher domestic labor costs. Ford initially absorbed costs but now raises prices on Mexican-made models. Tesla accelerates U.S. supply chain integration to reduce tariff impact. The industry trend is a retreat from global supply chains driven by tariffs. Companies face expensive, disruptive transitions in a volatile trade environment. Multi-billion-dollar investments are made amid uncertain trade policies. The reshuffling of production reshapes the North American automotive landscape. Tariffs and corporate responses lead to inevitable car price increases. Automakers pass costs to consumers, unable to sustain profit margins. Price hikes affect all vehicles, not just imports, due to global supply chains. Even U.S.-assembled cars face rising costs from imported parts. Shifting production to the U.S. is slow and costly, offering no short-term relief. Consumers face higher prices, straining budgets and affecting purchasing decisions. The new car market may slow, creating economic headwinds. American buyers are caught in a global trade dispute, facing higher costs. The era of stable car pricing is over, replaced by trade-inflated prices. The U.S.-Japan economic relationship is strained by automotive tariffs. Japan is the largest foreign investor in the U.S. with significant contributions to the economy. Tariffs threaten this partnership despite Japan's substantial U.S. investments. Japanese automakers have built extensive U.S. operations now challenged by tariffs. The trade surplus is offset by job creation and investment in the U.S. Japan seeks clarity on trade agreements to stabilize the economic alliance. Uncertainty complicates planning for Japanese businesses, affecting long-term strategies. The trade dispute risks deterring future Japanese investment in the U.S. The resolution will impact global investor confidence in the U.S. market. The trade war creates turmoil in the automotive industry with no clear winners. Automakers face billions in new costs, threatening profitability and strategy. Japanese giants like Toyota and Honda consider drastic actions amid financial losses. U.S. workers face uncertainty with potential job cuts and wage freezes. Consumers bear the brunt, with rising car prices affecting budgets. The tariffs' impact on domestic prices disproves initial assumptions. The trade conflict sets off negative consequences with few benefits. Strategic responses are defensive, with unclear trade agreements exacerbating issues. The road ahead is risky, with potential long-term damage to the industry and economy.